So we'll move on to the most important method in this entire video, that's NPV. So the meaning, NPV is the difference between the present value of cash inflow less the present value of cash outflow. Okay, so how do you find out the present value? We use a cost of capital. What is the answer that we get? The answer that we get is an amount. The higher the answer, the better. So when should we use? It is a final criteria that we use to select or reject a project. So we'll see the decision criteria for NPV. We have to accept any project which gives a positive NPV, and also like whichever gives us a higher NPV, that is the best project. We have to reject all the negative NPV projects. Okay, if a NPV comes to 0, that means that the cost of capital and the cash inflows discounted are same, so still we will reject it. From an exam point of view, these things are like very important, because in a 10-mark question, if you compute the answer and finally you say that whether you to accept a project or reject a project, that alone carries a 0.5 mark. So after computing, you say that accept or you say reject, that carries half a mark. Even when the answer is wrong, okay, even when the answer is wrong, but you still say that the project has a plus 1000 NPV, so we have to accept it. But in reality, the real answer would have been minus 2000. The real answer would have been minus 2000. Even though your answer is still plus 1000 is wrong, but you have correctly stated that all positive projects has to be selected as per NPV criteria. So you will get a half a mark. So that's how the marking criteria works. So this is a very simple NPV problem. We have the cash flows for 3 years, 100, 100, 100. We have the WACC or the discount factor. This is the discount factor at 20%. That gives you these numbers. Multiply both these numbers, you will get your discounted cash flow. So you got these numbers. Add all these numbers together, you get your present value of cash flow. The investment of this project is minus 100, so you get deduct it and you get your NPV. As NPV is a positive number, you are going to accept the project. Okay, it's a very simple problem. So we'll see what is the relationship between the discount factor and the NPV. The NPV of an investment is the discounted cash flow of an investment at the discount factor. So there's a direct relationship between discount factors and the NPV. The discount factor used in NPV is the WACC, okay, the weighted average cost of capital. If the WACC or the discount factor is higher, that leads to lower NPV. If the WACC or discount factor is lower, that leads to a higher NPV. Hence, WACC or discount factor and NPV are inverse in nature. So understand this very carefully, because you will be like again and again tested on this concept. Okay, so WACC or discount factor and NPV are inverse in nature. So we'll have a problem to look at it. It's the same problem. You have a cash flow of 100, 100, 100. Weighted average cost of capital or the discount factor is 20. You got these discounting numbers. You have discounted the cash flow. You got your present value of the company. Okay, or we can say this also as a NPV. This can be said as a NPV also. Now what we'll do is we'll reduce the WACC to 10. From 20 we will reduce it to 10. So these are the numbers. These are the discount factors. These are the cash flows. So this is our NPV. Look at our NPV now. Look at our NPV. NPV has become 248.6. See, by reducing the WACC from 20 to 10, from this number to this number, if you reduce it, it leads to an increase in the company's value by 38.1. Okay, if you deduct these answers, this answer from this answer, you will get 38.1. So it's like very clear. If you're going to, if your WACC is higher, your NPV will be lower. If your WACC is lower, your NPV will be higher. So they are inverse in nature. So we'll consider the features here. It is simple to compute. It is easy to understand. It considers the entire life of the project. It considers the cash flow. It also considers the time value of money. It directly adds to the wealth. So that is a very important point. It focuses on risk. Yes, the discount factor takes into account the risk. Additional calculations, we can do it. Is the answer a percentage? No, the answer is an amount. Okay, so that is where NPV we can summarize. So we'll see some general points about NPV. The good thing about NPV is a positive NPV should cause a proportionate increase in a company's share price. How come? Because NPV is a amount, MPV is a amount, and there is already a market capitalization. So whatever NPV you had, it gets added to the market cap, okay, and that will create a new market cap. Okay, so if you have a if your market cap is already like 10,000 crore, you have a project which will earn 1,000 crore, your market cap will become 11,000 crore, because the market will feel that this is a very good project and let's increase the share price. So immediately the share price would move from something like 100 rupees to 110 rupees. So that's how the share price gets moved. So what are the drawbacks of this method? NPV only gives the amount and does not relate to the size of the investment. For example, an NPV of 100 is a very good thing, but if it's for a project costing 1,000, it's a great thing because we get a 10% return. But if it's for a project which has a capital cost of 10,000, so then it becomes a 1% income project. Okay, so this was 10% income, but this is a 1% income. So NPV does not differentiate between whether it's a 10% profitability or 1% profitability. It just tells you the amount. So that is the drawback of this method. So now we'll move on to a quiz. Net present value as used in investment decision making is based on which one of the following? So on what number we do NPV? Net income? No. Earnings is also profit, so we don't use that. Earnings, again it's profit, we don't use that. We use the cash flow. So NPV considers the cash flows only. Answer is D. So we'll start with what is an IRR. See, IRR is the return that an investment will generate over its lifetime. Okay, so it's something like profitability, but not exactly profitability. Okay, it's something like profitability. IRR is the discount rate at which NPV of a project becomes zero. This is a very important point, so please remember it. IRR is the discount factor at which NPV becomes zero. Okay, it gives you an answer in percentage. The higher the IRR is better. Again, this is a method which is like equally important to IRR, but still NPV is superior to IRR. So that is a very important point. So what is the decision criteria? If the IRR is higher than the required rate of return, accept it. If the IRR is less than the required rate of return, reject it. Okay, so if IRR and cost of capital, okay, if IRR is 15% and cost of capital is 10%, then accept the project. If IRR is 15% and the cost of capital is 20%, then reject it. So that's how the decision criteria works. So this is a very simple IRR problem. We have a project which gives cash inflows for 2 years, so 100 and 100. Discount factor is 15%. We got the discount factor numbers. This is the discounted cash flow. We've added them. We've deducted the investment and we finally got a negative NPV. Okay. So we'll again compute the same problem with the lower discount factor. Why are we like lowering the discount factor? IRR is the discount factor at which NPV will be 0. So that is the IRR. So our job is to find out the NPV when it becomes 0. So that's the inverse relationship, right, between the discount factor and NPV. When the discount factor is higher, NPV will become lower. So if you are going to reduce the discount factor, the NPV will be higher. So IRR is a point at which NPV is 0. So the IRR is between, so the 0 is between these two numbers. Between these two numbers, the 0 lies. If 0 is between these two numbers, then the 0 is also between these two discount factors, right? So what we'll do, we'll again compute it. So I have computed at 12%. Okay, 12% is in between the 15% and the 5%. Yes, it's correct. If I work it out, I get an NPV of 0. So what is the IRR? IRR is the discount factor at which NPV becomes 0. So the discount factor is IRR, 12%. Let us discuss the same logic with the graph. So in a graph, we will take a plot like this. So this side of the line, we'll take it as NPV. This side is positive NPV and this side is negative NPV. This side we'll take it as the discount factor and we'll mark the center point as the 0. So it's a 0 NPV and also the 0 discount factor, this point. So we'll have the same numbers which we used earlier. We'll have like 5%, 10% and 15%. So for 5 and 15 we have computed and we got an answer of, when we had a discount factor of 5, our answer was 16. And when we had a discount factor of 15%, we had an answer of minus 7.4. So we'll mark those 2 points alone. So the stars marked at 2 points. Now what we'll do is, we already discussed that the NPV was, sorry, that we have to make the NPV 0, okay, because when it becomes 0, that is the IRR point. So our job is, somewhere the logic works like this: when we keep on increasing the discount factor, okay, the NPV will keep on falling down. So that is the logic. So we'll put the logic like this. So when you keep on increasing, so for 6% discount factor, this should be the point. For 7% discount factor, this should be the point. For 10%, this should be the point. 11%, this should be this point. For 12%, this should be the point. Okay, for 12%, that should be the point. Now where is the IRR? IRR is here. So why that is the IRR? Because IRR is the discount factor at which NPV will become 0. IRR is a discount factor at which NPV will become 0. So if you use a discount factor of 12, the NPV becomes 0. So that is what it's being explained there. So hope you have understood the logic here, because the same logic can be asked in several different ways. So is IRR simple to compute? Yes. Is it easy to understand? Yes. Does it consider the whole life of the project? Yes. Does it consider the cash flows? Yes. Does it consider time value of money? Yes. It uses the discount factor through which it uses the time value of money. Does it maximize wealth? The answer is no. Okay. Does it focus on risk? Yes. Can we do additional calculations? No. Is it expressed as a percentage? Yes. So this is a summary of IRR. So we look at this concept. So these are the advantages of using a IRR. The IRR provides the information on the margin of safety, okay, that NPV does not give. So you can also find out the margin of safety for a project, and you can also find out when you don't need to invest in a project. So you can also find out when the project would become uneconomic, okay, or a negative NPV. So for example, we'll take like this: a company wants to invest in 3 projects, okay, A, B, C. IRR is 20, 10, 20, 15, 11. Cost of capital is 10 for all the three. Margin of safety is the difference between these two numbers. So you got this one. So you just deduct them. You got this number. We can find out the margin of safety in percentage. So you can take the IRR minus the cost of capital divided by the cost of capital into 100. So that's a percentage. Margin of safety tells you how much the cost of capital should increase, okay, should increase to make the IRR 0, okay, to make the IRR 0. So if it indicates 100%, then the cost of capital should increase by 100%. So only when the cost of capital increases by another 10%, your IRR and this number will become same, okay. If your cost of capital has to increase by 50%, then your IRR on this one becomes equal. So here again the same logic, if it increases by 10%, that is by 1, your IRR becomes equal. So the logic is, this tells you what is the sensitivity of the project, okay. So which is the best project? Project A is the best one, because there's a what to say, there's absolutely, you don't need to worry about the cost of capital like doubling up or becoming another 100% higher, because that's not going to happen at all. But project C is like very sensitive, because there might be a chance that cost of capital can move by another 10% and the project will become totally worthless, okay. So even if you do a good job, still the project itself becomes unviable. So that's about the pros of IRR. It indicates risk. So we'll see what is the non-conventional cash flows. So a conventional cash flow looks like this. The 0th year alone, the cash goes out. All the other years, the cash comes in. In a non-conventional cash flow, the 0th year, the cash goes out, and also in some other future year, the cash goes out, okay. So this is a non-conventional cash flow. We will also see another example. So here in the 0th year, the cash goes out. Also in the 3rd year, the cash goes out, okay. So conventional is only once the cash flow goes out, and that's on the 0th year. But in non-conventional, apart from the 0th year, in some other year also the cash goes out. So that's about non-conventional cash flows. Now, if a project has cash outflows during its life or at the end of its life, in addition to its initial cash outflow, the project is set to have an unconventional cash flow. Just now we've gone through it. Projects with such cash flows, okay, unconventional cash flow, will have more than one IRR. That is a problem. So only for conventional cash flow you can do IRR. For unconventional, IRR will give you some different wrong answers. So don't do for unconventional cash flows. So we'll compare the NPV and IRR, because this is a very important topic and most exams ask this. So NPV can be applied for both conventional and unconventional cash flows. IRR can be applied only to conventional. NPV gives you an absolute number as an answer. IRR gives you a percentage number as an answer. NPV does not take the size of the project into account, but IRR takes the size of the project into account. NPV assumes that cash flows are reinvested at cost of capital. IRR assumes the cash inflows are reinvested at IRR. What is this? We will just see later. So we'll see the reinvestment pattern here. NPV assumes reinvestment is based on cost of capital, and IRR assumes reinvestment is based on IRR. So we'll just look at here. Okay. See, a company has this kind of a cash flow. 0th year you invest, then you get cash inflow. So this is outflow. Other years you get inflows, okay. You get the first year inflow of 4590. At the first year end you get 4590. Still, how many years are left for the project to get completed? The entire second year, the entire third year. So 2 years this money can be invested, right? Where can you invest it? NPV assumes that this 4590 can be invested at the cost of capital of 10% for the 2 years. Okay. On the second year end, you get 2735. This can be invested for when, as you get the amount in the end of second year, you can invest for the entire third year. So 2735 can be invested at 10% for an entire 1 year. But this 1500 you are getting in the last end of the third year, so that cannot be invested anywhere. So the concept is the rate. The rate 10% is something which is the cost of capital. That is any loan that you receive or any borrowings that you make. Okay, that is a normal assumption. So this 4590 can be invested in any bond or debenture which gives a yield of 10%. That is a logical assumption. Okay, or somewhere once you have got this money, you can even repay the debt also, the debt which you got to invest in this project. This is a reasonable assumption. But how IRR assumes? Assume that a project has an IRR of 20%. Okay, it's a very high IRR project and we have selected it. Only this project can give 20%. Okay, the 4590, if you use IRR, that money also we get, but it is assumed to be invested at 20%. See, this project that we selected based on IRR is the highest project which gives the highest IRR, right? The second project also will not give you this IRR. It will give you a IRR something like 15%. So how can we assume that we can invest the 20% in the same project? That is not possible at all. So this is an unreasonable assumption. Okay, that's why NPV is way better than IRR. So we'll still compare NPV and IRR. When discount factors change during the life of project, it can be incorporated in NPV. So that is possible. That's again a very strong point for NPV. Such changes cannot be incorporated in IRR. There is no such problems of multiple NPV and all here. But in IRR, we have the problem of multiple IRR. NPV directly adds to the shareholder value and the share price. IRR doesn't do that. So you can see that NPV is like far more superior to IRR. Put it like this. Assume there are two projects. Okay. Project A is there. Project B is there. Both have a NPV and IRR. A project gives you 100 NPV and this one gives you 50 NPV. IRR here it gives you 10% IRR. This one gives you 20% IRR. Which one we will select? As per NPV you will select A. As per IRR you will select B. Now when they give conflicting answer, which one you select? IRR is a poor method, NPV is the right method. Okay, so select NPV. So that's how it works. So we'll start with the quiz. NPV method assumes that cash flows are reinvested at IRR, accounting rate of return, or cost of capital. The answer is cost of capital. Okay, we'll move on to our next question. Which of the following statements about NPV and IRR is least accurate? So which one is like wrong? IRR is the discount rate that equates the present value of the cash inflows with the present value of cash outflows. This is correct. For mutually exclusive projects, if the NPV method and the IRR method give conflicting rankings, the analyst should use the IRR. This is wrong. That is what they are asking. Select the wrong answer. So we'll select the least accurate one. See, the NPV method assumes that cash flows will be reinvested at the cost of capital, while the IR rankings implicitly assume that cash flows are reinvested at the IRR. This is a correct one. So this is the false option. So we'll select that one. Answer is B. We have another quiz. Which of the following statement is true if the NPV of a project is 4000 negative and the required rate of return is 5%? So to work out this problem, okay, we have to do the graphical method to understand it better. So as per the graphical method, this side is a discount factor, this side is the NPV. NPV is 0 this side and it's like minus this side and plus this side. So minus 4,000 is what is given, and minus 4,000 is for a 5% discount factor. So for 5% discount factor and 4, we'll mark it here. So this is the point. He is asking you which of the following statement is true. Okay, the project IRR is less than 5%. Is it true? See, the IRR is the point at which NPV becomes 0. So this is the point. Okay, it cannot, IRR cannot be 5 because it gives you a minus 4,000 as NPV. So should you increase it or decrease it? If you increase the discount factor, the NPV will still fall. So that's not the option. If the discount factor, if you decrease it, okay, your NPV will increase because they are inverse in nature. Okay, so what happens is we'll increase it, and the answer comes to something like 3. At 3% discount factor, we'll just see that the answer comes to 0. Okay, so this is the IRR. Roughly we'll do it. Okay, if we decrease the discount factor, NPV will go higher. So we'll just assume that the NPV goes higher, and we get something like 3%. So is this right? The project's IRR is less than 5%. Is it right? The project's IRR 3% is less than the 5%. The answer is right. Yes. Okay. The required rate of return is lower than the IRR. Okay. So he's asking, is the discount factor, required rate of return, we can also say it as a discount factor. Is the discount factor lower than IRR? Discount factor is 5%. Okay, which is higher. That's only we are getting negative NPV. How can it be lower? Okay, discount factor is actually higher, right? Discount factor is 5%, and IRR should be less than this. That's why we get something like discount factor, IRR of 3%. If that is the case, this is a wrong choice. Okay, he's like distracting us. NPV assumes cash flows are reinvested at the IRR. No, it's reinvested at cost of capital. So this is wrong. The NPV would be positive if the IRR was equal to 5%. So if NPV is, he says if the NPV would be positive if the IRR was equal to 5%. If IRR is equal to 5%, then NPV would be 0, because at 5% NPV will be at any point of IRR, okay, whether it's 5%, 10% or 20% or 3%, at any point of IRR NPV will be 0. So this is wrong. It cannot be positive. It is 0. Okay, so the answer should be A. So this is a very lengthy question. So if you get a question like this in an exam, best thing is to do it graphically and then understand it and then work it out. But ensure that whether you could do this within some 3 minutes or 4 minutes. If you take more time than that, just flag this question and move on to some other easier question. This table gives you the entire overview about all the methods that we have considered till now. We have a quiz now. Which of the following capital budgeting techniques is most directly related to the stock price? Obviously, NPV. So the answer is A. So we have another quiz. Which investment appraisal method is generally considered the best model for long range decision making? If you have an answer of NPV, select that. Payback selects projects which are short term oriented. Their short term oriented are selected. Discounted payback also selects short term period projects. ARR selects the high profitability projects. It doesn't consider the length of the project. NPV is the answer. So the answer should be D. So in the past exams, we have a few questions in the section C. So these are the questions. Okay, why is NPV regarded as superior to IRR? Your view about an investment methods or appraisals, or what would happen to the if interest rate rises, Okay, what would happen to the capital investment appraisal? These kinds of questions might come in your exam. Mostly we have covered in a theoretical uh, view about this topic, so you can answer them well. So thank you very much for watching this video. We'll meet in the next video.